Well, good morning or good afternoon. Welcome to another Lendit Fintech Digital session, and we are delighted to have today what I would consider a rock star panel. We have two former heads of the OCC. We have two former heads of the Innovation Office at the CFPB, and to talk to them all, we had to control the conversation and to kind of bring out the best in our panelists. We have the CEO of the leading fintech bank in the country, and super excited to talk about what's going to happen in the new Biden administration, what it means for fintech. With that, I will hand over to Gilles Gade from Cross River Bank. Over to you, Gilles.
Thank you, Peter, and great to be here. A great panel today, and very proud to be presenting on behalf of Lendit and the OLPI. So we have here Tom Curry, former controller of the currency, currently a partner at Nutter McClellan and Fish. We have Keith Noriarka, who was also a controller of the currency, and now is a partner at Simpson Thatcher and Bartlett. We have Dan Kwan, who, and all these individuals, by the way, I've known for a number of years, managing partner at Bank Street Advisory, formerly head of innovation at the CFPB, and then finally Paul Watkins, recently head of innovation at the CFPB as well, and he's at Potomac Global Partners. So I'd better behave today because any of those gentlemen could actually come back and haunt me when they take the helm of either the OCC, the CFPB, the FDIC, or any other agency that could come and bother us as a financial institution. So I won't bother you too much. I would like to bring some levity before we kick things off. So very quickly, rapid fire for the entire panel. Who will win the Super Bowl this year? Dan.
I'll pass the question.
Okay, Tom.
Hey, I'm a former regulator. We don't gamble.
Okay, it's not a gamble. It's not a bet. Paul, anybody's going to take a risk.
Buccaneers.
Buccaneers. Is that because of Tom Brady or just because really
As you know, I'm just trying to stir up controversy with folks in the Northeast there. So I really don't have an opinion.
What do you think?
Well, I'm from Pittsburgh, so I'll just go with the Steelers. How about that?
Okay, very good. All right. So let's kick things off. A question for everybody, for all the panelists. And this is really a fascinating subject that we're going to be touching upon today. We're really at the crux of a change of administration, which may trigger a change in the way that the administration is looking at fintech or financial services in general. And really to kick things off, as innovation continues to evolve at a very rapid pace, and this has been the case for the past few years now, what are some of the top priorities that the new administration and the next Congress should focus on? And when you discuss this, when you address it, we'll start with Dan in a second. What are really the opportunities and the concerns that you think that the administration should bring forth?
Sure. Should I go, Michelle?
Yes, please do.
Sure. Thank you, Jill. Thanks, Lendit Fintech, to do this great panel. So in my mind, the next administration and the Congress should focus on two things, and I think none of these things should be a surprise to the audience. So obviously, one is open banking or open finance. The other one is AI. So on the open banking side, I think the CFPB is already taking the leadership in releasing an AMPR under 1033, and I expect the Bureau will continue working on it in the next couple of years, and which will probably lead to a final rule under 1033. Now, on the Congress side, I think there's a lot of discussions about balancing the privacy concerns as well, and also the importance of expanding the access to the data. So I think what we see in other jurisdictions where the movement has started in open banking, now has proliferated into open finance. I think in the United States, a lot of conversation these days are really centered around not just the data held in financial institutions, but also in other places such as the payroll providers or IRS or even utility companies. So it may be interesting to see if the Congress is willing to expand the definition of covered persons under Dodd-Frank, to expand the data sharing, not just in the banking system, but also beyond that. Now, on the AI side, I think there's a lot of conversations that really about the potential discrimination of using AI, the black box problem, but also the transparency issue. And I think this is the case. This is the area where I think consumer advocates and the industry can really work together, not to demonize AI, but also try to understand how the machine learning algorithms can expand access to credit.
Okay, thank you, Dan. Tom, we'll go with you next.
Thanks, Gilles, and thanks for hosting the program. I think the big issue is really what's the national strategy to regulate or not regulate fintech and financial technology in general. I think there's a lack of clarity as to what the future should look like, whether it's who should be able to engage in what were traditional financial services versus the consumer issues that Dan was talking about. I think that's going to be the real challenge, to develop a consensus, particularly between Congress and the incoming administration. Again, we need to really have a rule book that reflects what's happening in terms of innovations in technology, issues as to, again, not only who does what and how they're regulated, but also some very, basics in terms of how financial transactions are settled, whether it's through blockchain or other digital technologies, whether there's a development of private or public digital currencies. All these things need to have a regulatory framework by which, or under which, whether you're a prudential regulator or a consumer compliance regulator, how to proceed. And again, it'll be interesting to see how quickly that occurs and what it'll look like in the coming 4 years.
Thank you. Paul, we'll go with you next.
Right. Well, thank you for this opportunity, and what a great panel. I agree with Peter. The only thing better would be if we could have this conversation in person, but until then, we'll enjoy this structure. To me, the key theme here is, can we free financial services from its silo? And I want to approach that organizationally and also through a policy perspective. Financial services regulators are isolated from the rest of the executive branch, and this creates real problems that I hope the Biden administration will address. When you look at something like the National Economic Council, we've got the Department of Agriculture. Now farming is about 0.6% of a GDP, financial services more than 10 times that. The regulators aren't on there. Department of Agriculture is. Treasury right now is treated as a proxy for the financial regulators in policy discussions within the executive branch. I think that's a mistake. It's not a proxy. The regulators need to be integrated into that system for the benefit of the economic policy goals that the Biden administration has, and also for the benefit of the regulators, because as Dan mentioned, these regulators are now facing really complex technical problems around AI and other applications. And they're searching for where to find that expertise, because many of them don't have it in-house. That expertise may be in Office of Science and Technology policy, it may be in the defense agencies, and the regulators need to work with the rest of the executive branch to be able to form a strategy. Then from a policy perspective, the key question is, are we going to let consumers use financial services along with other products as they want to? Or are we going to pretend that we can isolate financial services within this banking box and keep it separated from other products and still lead the world? I think that is not the right approach. And I hope the administration and Congress recognize the global competitive dynamics that Tom was talking about.
Thank you, Paul. Keith, we'll go with you last.
All right. Well, again, thanks for having me too on such an illustrious panel. It's great to be with you all virtually. Hopefully we can do it in person sometime soon. I agree with what everyone just said, so I don't want to belabor it too much, but I think, the biggest challenge facing the incoming administration, especially on technology type issues, is, coming to a consensus among themselves. I mean, I think you do see in what you heard from the other speakers, the agencies, have their own jurisdictions, a lot of which they guard jealously. And I think in many ways that creates issues as far as to coming to sort of one view or one voice on sort of a more national, idea of how to regulate, promote, and structure this type of activity in the banking sphere, as well as also deal with the existing institutions and how they have to change and transform. So I think that's the challenge. There are different means by which the agencies can do that. FSOC has been a coordinating force in the past administration, but I think these currents, it's not like this is an issue that really cuts across political ideologies. I think on both sides of the aisle there are those who embrace technology and those who are more jealously guarding the current sort of status quo. And I think that's a lot depends on who is picked to go where and what type of vision and leadership they have as far as what we might see from the new administration.
Thank you. We're going to delve into all these subjects a little more in the next 40 minutes or so. One question that I would like to address to all again, maybe this time we'll start with Paul. Fintechs, as you know, were instrumental in delivering billions of dollars to the smallest businesses across the country that are nowhere else to go. And now that the government is contemplating another stimulus package, do you believe that the current the incoming administration will continue to rely very heavily on fintechs to deliver those stimulus packages, or do you believe that they will take a different route? We'll start with Paul.
So I think fintechs will continue to be involved. There were great success stories from the fintech angle. There were also some indications that additional work can be done on fraud prevention and some of the areas that were problems throughout the disbursement process. So I do think fintechs will continue to be involved. They were able to reach folks that were hard to reach. They were very nimble. I think in many cases there was a good consumer experience. But when we're talking about the recovery is not primarily about the government disbursement of funds. So as far as relying on fintechs for the recovery, I think the key question will be whether the government can properly regulate on some initiatives that are in place, record collection under 1071, treating small businesses more like consumer lenders. These are key questions that I think will probably do more to drive the scope of the recovery than just the disbursement of funds.
Okay, thank you very much, Dan. What do you think?
So yeah, I don't think the Biden administration will have any choice but to rely on the fintechs, especially in terms of, when it comes to delivering funds expeditiously to small businesses. The consumer part is hard. I think the IRS still faces a lot of challenges. I think some of the consumers still haven't got their stimulus checks yet at this point. This is a more systemic problem than the small business. I think that's purely because I think a lot of the people are forced out of the banking system or choose not to have a bank account. And I think, I'm hoping in the next administration, the Biden administration will actually work with the industry. And really, I think what we see in the COVID, in this crisis, the digitization has been accelerated. So I really want to see the government actually taking more time and spending more effort to really expediting the digital transformation. And so whether it's a CBDC that a lot of people are talking about, which I think is still have a long way to go. I don't see that to emerge in the near future. But I think when you see PayPal, Square, all these big guys, big tech companies, fintech companies, using their digital services to enable digital financial transactions, I think there's a lot to be done, and I think the government can definitely play a more of a facilitator role.
Okay, thank you, Keith. You're next, and then we'll close this one with Tom.
All right. Well, I agree again with both what Paul and Dan said. I don't think there's a choice. I think that what you're seeing is the new way of the world, especially in times of COVID, on how to communicate with people quickly. So I think that the digital channels are here to stay. I think the challenges that Dan and I likely Tom will indicate are there as far as ways to regulate it and protect consumers and make sure they're not defrauded. I think that's all going to be at the top of the heap as far as what needs to be addressed.
Thank you, Tom.
Yeah, no, I agree with my colleagues. I do think there's going to be greater attention on electronic or digital delivery of public benefits, whether it's COVID related or in the ordinary course. And I think there'll be a serious look at individual accounts at the Fed, whether it's through their existing technology or through central bank digital currencies. I do think, going back to the regulatory structure, I do think we need to pay more attention as to who's providing these payment services and where the risk of loss is. I think that needs to be thought through a little bit more, and that really goes to, the level and type of regulatory oversight for non-bank providers of payment services.
Okay, thank you all. Now, let's get a little bit deeper into the subjects that we just touched upon on the surface. And this question is really directed to Dan and Paul, as both having have stints at the CFPB. How can fintech be used as a partner to help accomplish the Biden administration's goal of expanding access to the financial system and particularly shrinking the racial wealth gap? I mean, this is something that is going to become more and more prevalent, particularly. We see that it's going to be front and center of the incoming administration's agenda. Would love to hear your thoughts on this one.
Should I go first?
Yeah, sure.
So great question. I think a lot has been done, I think, in the past couple of years in terms of government engagement with the fintech industry. But we should also we shouldn't be under the illusion that the fintechs can fix all the problems. So especially in terms of wealth gap, this is a much bigger economic and socioeconomic situation than financial services can address. But fintechs definitely can play a very important role in terms of providing a more convenient service, lower cost delivery system for consumers. One of the things I would caution the administration is that government should play a role such that it's a facilitator. It sets out the rules clearly so that people know how to follow the rule. The government shouldn't be playing the role of creating financial services. So one of the things that I will be cautioning the new administration is that, for example, in the Biden-Sanders joint proposal, there's a recommendation to set up a public credit reporting agency within the CFPB. Number one, I think this is something that's probably very important. It's very difficult to accomplish. You probably need a congressional action to do that. But secondly, even with that kind of possibility, I still think it is really not a role for the government to do that. This is really left best at the private sector. Now, I'm not diminishing the problems that the current CRAs have today, but I think the government should actually take a more pro-technology, pro-innovation approach, pro-competition approach. So we briefly talk about AI and machine learning. I think these are the things that can potentially really expand access to credit. And I think the regulator should actually overcome the fear factor, really try to embrace that. And with a lot of expectations, during my tenure at the CFPB and when Paul was there as well, in terms of issuing no action letters, providing more guidance, I think this is something that the regulators should continue encouraging the industry to experiment.
Thank you, Dan.
And I would just build on what Dan said, and I agree completely. Want to focus clear rules of the road, I think, are going to be key here. There are folks who want to help solve these problems, and technology can certainly be part of that solution. So first, the regulators need to make sure that they're doing no harm. Yes, enforce ECOA, enforce the laws, watch for violations. But if you make this process too burdensome and too harmful, too difficult for companies, then they can't enter the space. And so this should be a factor in approving bank charters and in all sorts of areas throughout the government. Dan mentioned no action letters, and a letter that was issued when he was at the Bureau to Upstart, I think, has been an important guidepost here. There have been individual agencies issuing guidance, but again, what's needed is some centralized, I wouldn't say not coordination, but direction from the administration, saying everybody needs to get on the same page on what our standards are. Here's what our economic and social standards are going to be in this administration.
Thank you both. Now pivoting to Tom and Keith, on a question regarding the fintech charter. So this was Tom's baby, and he actually made the announcement of launching the fintech charter idea at an OLPI event in Washington D.C. So we were grateful to be part of that adventure. So now, in retrospect, after X amount of years of the endeavor has been, and it has been followed up by your successors. What is the state of affairs of the fintech charter? Do you think that's been embraced by the fintechs? Do you think that it hasn't been enough embraced enough by the fintechs? Do you think there's still a lot of juice going for that endeavor? Do you think it needs to be changed to the way it's being conducted right now, the way it's been implemented? What are your thoughts, really briefly on this one?
Yeah, thanks, Gilles. I think we've had a unfortunately long history with the OCC FinTech Charter. Unfortunately, it's been beset by litigation from the states, including the state of New York. Given the current state of the litigation, I think we'd have to wait a year or more before we get a final word on the authority of the OCC to charter a special purpose bank that doesn't perform all three functions of a bank, making loans, taking payments, and accepting deposits. It's quite possible with the new administration that they may actually drop this initiative and drop the litigation. That's something I think that's on the table. But the issue still remains. I think fintechs are looking for direct access to the payment system, which can only be through a bank, however you define that. And there have been some creative, workarounds in terms of going for a full service national bank charter, like Borrow Money, using a ILC charter, and more recently, a not quite clear proposal from the OCC to have a national bank not accept insured deposits. It'll be interesting to see how the current administration views these avenues, other than a straight full service national bank with FDIC deposit insurance and holding company regulation. I do think that there is some hostility to the more creative types of charter avenues from particularly the House of Representatives.
Thank you. Keith?
Well, look, I think that Tom had a good vision that the sort of banking business is changing as it always is changing, and in particularly with focus to technology. I think the real genius in the original idea was that to try to get this stuff back into the banking system rather than the banking system make itself obsolete. And I think that vision is one that sort of kept the charter going. There are sort of legal uncertainties and the like. I agree with Tom. I think a lot depends on who's sort of running the OCC and what their vision is. Again, it's hard to forecast that now until we actually see who's chosen to be there and who's sort of on the regulatory teams. But I think overall, the overcurrent, if you want to say, like the big wave sort of crashing over everyone, is that this change is here and it's happening. The question is, where is it going to happen? And I think the idea of giving these entities a carrot to come into the banking agency, but having to then comply with all of the rigors of being a regulated bank is a good idea. And it was a good idea back when Tom did it, and it's still a good idea today. And otherwise, it makes it a lot harder to have to sort of envision some grand regulatory scheme, implement it, have it survive court challenge. I mean, you know, people's terms in office will be over by the time all that's finished. Whereas you do have sort of a prepackaged system already. You know, banks are heavily regulated. The compliance functions, you know, very strict and thorough, and they're heavily regulated. And the idea of letting those institutions either come in or partner with regulated banks makes a lot of sense. And I think that idea overall will carry it in some form, you know, maybe not in a particular, you know, charter, because it might be litigated, or there might be an injunction, or someone drops the litigation. But I think overall that idea is going to be with us, and maybe it does manifest itself in the full service banks like Vero and the like. Maybe there are other things that people do, like the figure application of taking not deposits or uninsured deposits, and somehow trying to satisfy the legal terminology. And that's, you know, Tom and I are lawyers, that's sort of what we get paid to do. But I think the overall policy and inertia, if you will, is toward you know, the changing of banking. And so the question is, are you going to keep it in, or are you going to have some type of disintermediation event? And I think that sort of has greater financial risks to the system, to the financial system, the banking system, and also makes it a lot more complicated and risky proposition to regulate.
So Keith, we'll stay with you, and that's a question for everybody. And exactly on that subject, pivoting to the bank partnership model. So have the banks really stepped up and changed themselves to embrace the fintech revolution? Are the regulators in tune with what's happening at the banks to enable them to bring those within the confine of the banking system, so that exactly for the reason that the fintech charter was created to begin with, like you rightfully said? So do you think that the banks are doing a good job? Do you think the regulators are keeping a close eye? Or do you think that there are still some bad actors that manage to get through, which is the reason why a lot of the states are challenging the business model to begin with, particularly with, you know, value when made, with TrueLender. So these are still being challenged in certain courts. I mean, there's the another thing I would love for you to comment on, which is the Colorado settlement. So these are really demonstrative of the fact that the bank partnership model is actually working to some extent, but is it limited? And is it limited to lending, or can it be pervasive? What are your thoughts on this one?
Well, look, I'll start it off, and then I'm sure the others have lots of ideas as well. But I think it has to work. I mean, in the sense of if people need to clear payments, they most likely have to go through the banking system. We may talk about cryptocurrency in a moment, and I think again that's another reason for the regulators and the industry to stay a step ahead rather than a step behind. In encouraging these, relationships, get them mature and solid, so that they can come through the regulated banking space, and we can look at things like AML, KYC, all those type of risky activities, as well as consumer protection and the like. But as far as the banks and regulators, I mean, I think the banks clearly, that they sense where the business is. So, clearly, I think they're as on top of it as they can be. I think regulators, since Tom's time, I mean, and before, third-party relationships have really been a strong area of, regulatory scrutiny and an action item for banks to really scrutinize. Now, are they on top of it as far as, from risk management and regulatory items? They can always do more because it's always changing. And I think that's sort of the dynamic aspect of the regulation is what sort of we all have to get a little bit more comfortable and better at, because I think a lot of bank regulation is reactive rather than proactive. But I think the fundamental tools and backbone are there and always have been there. But whether that needs to be strengthened or emphasized, I think that's always the case. And that's why it's so important to even have conferences like this and have regulators, be on top of these issues of where the industry is going, because it can be so very easy to sort of miss things that they're unaware of.
Okay, Paul, we'll go with you next.
So I do think this model is going to be increasingly under attack. I expect that somebody will have to intervene in the litigation against some of the OCC and FDIC litigation that the states have brought in the Northern District of California. I doubt the next administration will defend those. Maybe the Colorado model is a model that will work going forward. I expect that this may be a model that works in part of the country, but doesn't work in the other part of the country. So folks involved in this, I think it'll be incumbent on them to make sure they're gathering really good data to show how they are helping consumers. So at some point, hopefully we can go back to each state through its banks being able to access a national market and achieve some of these efficiencies that will help, that play a role in alleviating some of the financial inclusion issues that we've been talking about.
Thank you, Dan. What do you think?
So, I mean, I agree a lot of pretty much everything that Keith and Paul just talked about. I think, I mean, Gilles, you've been in this business since you started Cross River Bank. Back in the days, banking as a service was not even a term, right? Now everybody wants to be a banking as a service. So many banks are in this business. So that it's not because banks want to do this, it's because there's a consumer demand. So consumers have already voted with their feet that they wanted to have a variety of services which are currently not best offered through their existing banks. So I think this goes beyond just the existing challenges from states on value made or true lender issues, but I think more broadly, regulators need to take a very, very serious look at the existing guidance on third-party vendor risk management. The FDIC has been thinking about this for quite a while. They issued this RFI on industry standard or voluntary standard. I think, I'm not sure where that goes, but at the end of the day, consumers need that kind of service, and the regulators need to really think about how to bring these services into the banking system and make sure there's an appropriate oversight, but also not to be too burdensome.
Good, thank you. I believe, Tom, you next.
Yeah, sure. I think you made an interesting point initially, Gilles. The bank partnership arrangement is really an important way for smaller community banks to actually be able to integrate new technology into their menu of services for their customers. And I think that's going to be an important tool for them to remain relevant as technology increases in the business of banking. In terms of the third-party guidance, as Keith mentioned, that's really is critical from a prudential standpoint and in terms of defending against cybersecurity and anti-money laundering type of issues. So a strong framework really is important for everyone. As comptroller, I think some of the framework should be adjusted for community banks. I think there's too much of a one-size-fits-all, and there's also an opportunity for more collaborative due diligence activities by community banks in particular. I think the issue with the true lender proposal, the rule from the OCC, is that it fails to actually emphasize the OCC's oversight role through the third-party guidance. I think that's a weakness of the rule, that it does not, the OCC has not spelled out in the rule that they will vigorously enforce or apply the third-party guidance. As you and other banks know, that's an important tool to keep predatory actors out of the banking system and misusing the congressional authorization for interest rate exportation. So again, I think this is an opportunity where the regulators, whether it's the OCC, FDIC, or Fed, really need to use their supervisory powers to enforce appropriate behavior, non-predatory activities by bank partners.
Thank you, Tom. I will stay on the subject just for a little bit longer. Question for Dan and Paul. And by the way, Tom and Keith, please feel free to chime in as well. with regards to some regulations, do you believe that there's a need to revamp some of the regulations pertaining to the bank partnership model? There are certain regulations that are definitely obsolete or that could be adapted to modern ways of conducting the business of banking, such as using the internet, right? E-signing, for example, or other forms of electronic payments. Do you believe that the Biden administration will embrace the digital age and try to revamp some of those, propose certain promulgation at the legislative level to be able to advance the debate? And that definitely could be bipartisan, because there is definitely a need to modernize the overall infrastructure. Because if not, that's going to put the banking industry as a whole, particularly the community banks that are not equipped to be able to, to conduct the third-party oversight that they are required to do. It's going to be very cumbersome, very expensive, and they're just going to be left behind. What are your thoughts on those? Dan, we'll start with you.
Oh, sorry. Yeah, so I'm not sure if there's a specific regulation that needs to be revamped. I think on the third party, it's really at this point, mostly, it's really about the guidance. And as you know, you know this very well, guidance is always tend to be very high level, very principle based, very different from the regulations that we're used to, which tend to be very prescriptive. So I actually would like to see more prescriptive regulations in this case, so that the third parties know what exactly they're expected to do, and the banks know what they're expected to check. So maybe I can just take take the data sharing, the open banking as example. So when the fintech sign a data sharing agreement with a bank, and the bank, this in the case of large bank, they always have very detailed, onerous requirements, which are fine. But the problem is, once you have this agreement with one bank, when you go over to another bank will actually have a different set of requirements imposed on you. And those requirements are very similar, but they're not identical. But they all claim they follow the guidance from the OCC or the Fed or the FDIC or the CFPB. So I think there needs to be some really clarity on how these guidance is really going to work, because otherwise you're talking about repetitive, burdensome third-party vendor due diligence over and over again, even though some of the third-party consultants are used by the same banks, but they're doing the same thing, but just to check different boxes. I think this is something has been around for many years, and I think unfortunately regulators, for whatever reason, they haven't really focused on those issues.
So I think that this is an area where a lot of progress could be made, but the key question in my mind is, will this sort of regulatory policy be part of the economic agenda, or will the regulators be off in their own silo, kind of separated from that agenda? If they're part of the agenda, then I see the potential for a tremendous amount of common sense reforms to bring in this new era of banking. If the focus isn't there, then I'm much less optimistic.
Okay, thank you. Let's talk about CRA a little bit, just sticking with bank regulations. Any changes there forthcoming? Anything that you foresee with the digitization of money? Obviously, a lot of the exchanges between deposits and loans are very disjointed, and a lot of the actors are not being subjected to redeploying in the spirit of CRA, the way it was promulgated to begin with back in the 70s. What are your thoughts on any forthcoming changes to CRA? Do you think it is needed? If it is needed, in what form and shape do you believe it is? Keith, we'll start with you.
Well, look, I think for better or for worse, the OCC sort of has kicked this all off by sort of adopting new and different CRA rules. So I think there's already a lack of equilibrium, if you will, between the banking regulators. So there's a perfect opportunity, with even now, but certainly I would think with new regulators in place to bring more uniformity back, and in the process to update and modernize it. I think that's always been the issue. I think a lot of people across the aisle always realized that the rules were somewhat out of kilter with the modern practice of digital banking, and that's only multiplied in the past 4 years. But I think the question has always become, what's the solution to it, right? And clearly, the current regulators, the three of them, couldn't agree on that in the past 4 years, and so we have a different variation. We have Governor Brainerd talking about reforms as well. So it does seem like reforms on the menu, but the question is what variant or flavor that's going to take. I think remains to be seen, but almost it has to account for the new way of banking, that deposits are separated from physical branches, but that there are so-called banking deserts out there in the country, and so I think those are the things that need to be accounted for. But whether they're going to be strict metrics or the like, it probably won't look like what the OCC decided on, but it will look different than what the current regulations still in place by the other regulators are. So I can hazard a guess that far, but would like to hear from the others too.
Thank you. So who wants to take that next?
I will. I think we have a real problem with the CRA. I mean, it was enacted in 1977. How you treat digital banking really is an issue that needs to be solved. I do think there's an openness on all sides to come to a consensus on that issue. When I proposed in 2016 the special purpose Fintech National Bank, part of the goal was to actually develop an alternative assessment for digital banking. And that's what the financial inclusion requirement was all about. And basically use that as a pilot to see how best to adapt the CRA to a digital banking model. I agree with Keith. I think that with new faces, I think there will probably be a drive to come to a new consensus on CRA. The Fed, I think, will actually be, its ANPR will actually be the vehicle for potentially the three agencies to come out with a joint NPR that will address some of these issues. I think they will borrow some of the provisions from the OCC, but there really is, with something like CRA, a need for a uniform regulatory response. You really can't have multiple regulatory approaches to the same issue like CRA.
Okay, thank you. Dan, Paul, any thoughts?
I'm good.
I defer to those folks on the CRA, that's for sure.
Thank you. All right, so let's move to an important topic. I think I saved the best for last. With regards to cryptocurrency, cannabis banking, all modern ways of conducting banking. Some of these are obviously federally not allowed or frowned upon. There's more and more embrace for recreational cannabis in various states. We saw this in the recent elections. What are your thoughts on, from a regulatory standpoint and then from a banking standpoint, to be able to regulate this properly and for the banks to conduct the business in a framework that is that preserves the the integrity of and the protection of the consumers? We'll start with Dan on this one.
So I think I'm gonna punt the question on marijuana banking, but I would like to talk about cryptocurrency, which is something that I think a lot of people will be interested in. So I think the OCC has done a lot of thinking on this one, and with the two interpretive letters they issued recently on custodians, the custodian role the bank can play, as well as on the stable coins. And I think this is inevitably going to enter the cryptocurrency is inevitably going to enter the banking system. And China has already experimented with the CBDC. And there's a lot of promise, at least, people talking about the promise of CBDC to expand access to digital banking and for this to facilitate the financial inclusion. So my view on this one is I think there's still probably a long way to go. Bitcoin has been around since 2010, and I think they're still a minority assets in the grand scheme of things. And I'm not of the view that the government will have to issue a CBDC, and I think this is still something that being experimented by other countries. And in terms of the role of the Fed in this one, there are multiple proposals. I think if it's issued directly by the Fed, I'll have deep concerns about privacy issues. But if it's still done within the sort of the tiered banking system, I think we still have the similar problems where there are people, there are consumers who will not be part of this of the digital banking system. So I think the same problem we're facing today will probably continue to exist even if the CBDC is issued.
Thank you, Tom. You have some thoughts on cryptocurrency or any
Sure.
other context you'd like to?
I think the watershed event was really the launch over a year ago of Libra, which is now, I guess, Diem. That really, I think, forced the central banks to rethink their approach to central bank digital currency. The Bank for International Settlements recently published an agreed upon set of principles that individual central banks should explore as they develop potential central bank digital currencies. I do think there is a role for the central banks. Part of the BIS and Financial Stability Board activity in this area focuses on the financial stability impacts of a private digital currency. And I do think that financial stability is a central concern of the central banks, including the Federal Reserve. And if there's going to be a widespread digital currency, it'll probably be issued by a government central bank. The concern, I think, is legitimate, is that if there is a central bank digital currency, whether or not to allow individual accounts, and whether that can be a potentially destabilizing event for traditional banks in times of crisis, where you're going to keep your deposits at a FDIC insured bank with potential excess losses, or with the central bank. So some of those issues need to be resolved, but I do think the Libra Diem announcement and its potential launch was a wake-up call for the world's central banks.
Thank you, Keith. We'll go with you next, and then we'll close that one out with Paul.
Sure. Well, I will at least say a word or two about the marijuana banking, because I think that's just a constant headache for banks and the like, as municipalities and localities move to make recreational marijuana or medicinal marijuana legal. I think there's still the headache for regulators and banking institutions, given the federal laws, right? It is a federal felony, and how to deal with that. Now, there's been some comfort given in the Obama administration from the Justice Department, and we may see more of that, but there's a long statute of limitations on the crime, and so I think it's a very high risk area of banking, much like fintech. I mean, I think we want to get those people into the banking sphere so we can sort of more monitor what they're doing, not doing bad things, and the like. So I would hope, but I do think this has to be congressional action, that we can get some relief from the Controlled Substances Act to try to maybe more normalize this at the federal level. And I think a lot will depend on who the new administration has sort of running the relevant parts of the Justice Department and the like. As far as cryptocurrency goes, I agree with everything Tom just said. I do think it's one of those things, maybe a little bit more manageable in some ways, at least from the legal exposure, criminal legal exposure side, at least until you do bad things with it, than marijuana. But it's here, and I think what we're seeing is just a recognition, as Tom said, when Libra did it. I think that was a wake-up call for most of Washington. But we are seeing sort of individual actions. I know that sort of Tom and I had talked about, just privately about there are a number of things, like, for instance, as sitting in the comptroller's chair, that national banks can do just through their trust and custodial powers. But I think, the real question for bank regulators is, how do you sort of deal, with the clear and present issues presented by cryptocurrency. And one is authority, another is compliance, both as far as consumer compliance goes, and that cuts across a number of different regulators, but also, money laundering and things like that. Knowing your customer, but if your customer is an exchange, do you have to know your customer's customer? That type of thing. And I think that just gives rise to a lot of issues that people are thinking about, but will need to really think about in the next 4 years.
Paul?
The key question here is, do we want to win? You started off with a football analogy. We've done a lot of blocking in this country. We block WeChat, we block TikTok. Blocking doesn't move the ball. Somebody's got to come behind the blockers with the ball and go down the field, or you don't win. So we cannot simultaneously say distributed ledger technology is a critical and emerging technology. We want to outcompete the world in financial services. We're going to block these alternatives, and then we're going to block any US company that tries to launch something like Diem. Let's pick what we want. If we want to win, let's provide a path forward for the private sector. We're not going to lead through the central bank. We are far behind on real-time payments. Those are still at least 4 years out. Digital currency, even if it's a good idea, is even behind that. The only chance that we have to win is a private sector alternative. Let's provide a path so that that is a realistic probability and people will comfortable investing the sort of capital that it's going to take to build a really great product in this space.
Okay, thank you, Paul. Okay, so we have a couple of questions from the audience. I'm going to start with one from an anonymous attendee. So Financial Services Chair Waters sent President-elect Biden a list of items that she wants to see in the new administration roll back, for example, True Lender. What, if any, of this list do you think will be accomplished in Biden's first term? Does anybody want to take that one?
I'll start, Gilles. I do think it's a clear indication of what some of the priorities are for at least the progressive wing of the Democratic Party. Chairman Waters is certainly influential as chairman of the House Financial Services Committee, so I think the administration is going to pay attention to her lengthy letter. I do think it'll have an impact on chartering activity and potentially the bank partnership model. How much of an impact, I think we'll have to see when individuals are selected to fill out the agency appointments and what their views are. But definitely the letter raises issues about the Fintech charter, the ILC charter for Fintechs, True Lender issues. Those are all going to be sorted out by the leadership at the banking agencies and with the administration in terms of any affirmative legislation that comes out of it. Again, the other thing that I think will impact it, at least from a legislative side, is the results of the Georgia election and who controls the Senate. And that's really the big question mark, at least for the interim till January 5th.
Any additional thoughts on this one?
I think those ideas will be influential. I'm sorry.
Go ahead, Tom.
I'll just go quick here, Dan. I think those ideas will be influential among the financial regulators. And I would expect to see a number of them implemented. I mean, I think this will be sort of, there's an old tale of the hikers who run into the bear, and one of them starts running and the other two say, you can't outrun a bear, are you crazy? And they say, well, the hiker says, well, I can outrun the two of you. And I think we've got three hikers. We've got banks, we've got fintechs, and we've got large tech companies. They're going to try to outrun each other because I think there's a lot of new activity that's going to be coming out of Washington.
Yeah, I think I'm just actually reading the list now from Chairman Waters. I think there are a lot of things that she's asking President-elect Biden to do on day one. I think a lot of things probably can be accomplished, including the leadership change at the CFPB, in terms of the increased enforcement activities at the Bureau, especially on UDAP, And in terms of revisiting the payday rule, which has been changed, and I think probably will likely be changed again under the new leadership, and also on the debt collection rule, which was recently finalized. I think there's potentially another opportunity to revisit some of the things which I think a lot of progressives don't like, or think at least is inadequate. And obviously on the ECOA, on the ECOA enforcement, I think there will be increased focus on that as well, which we haven't seen much activity in the past couple of years.
Okay, thank you, Dan. Any other thoughts on this one? If not, we'll move on to the next question from the audience. Okay, let's take another question. So how much of the opposition to fintech charters is rooted in opposition to high-cost lending facilitated by non-bank lenders partnering with banks? Do you see any opportunity for some kind of grand bargain that simultaneously resolves the related issues of true lender, valid when made, and non-traditional OCC bank chartership? Maybe a question for Tom on this one, and Keith.
Keith, do you want to start?
Well, I mean, I think the people have thought about sort of grand bargains. First, I do think a lot of the opposition does come from high-cost lenders. I think the second part of the opposition comes from just banks trying to preserve their monopoly over the payment system. But if you just take the lending side of it, I think the problem has always been, it seems like the cost to a legislative solution to true lender and valid when made has always been sort of a national interest rate cap of potentially 36%. And, I think there are a lot of people in the industry who wouldn't want to pay that price. And then secondly, I just think, maybe just more sort of looking forward. I mean, we're in an extremely low interest rate environment. There were studies done, probably when at the end of Tom's term, when I was there, like even banks trying to make small dollar lending. I mean, a lot of them couldn't make the 36% work. So, I think there, may be larger issues as far as access to, to liquidity and lending, that could raise. So I think that's sort of the big political impediment, at least that I see. And unless someone's being willing to be a little bit more flexible with the 36% cap or take something else as a price for it, I don't see there's a legislative compromise coming.
Tom, any counterpoint on this one, or?
No, I agree with Keith. I think the real issue is differentiating between predatory lenders and a valid banking partnership. It's having people acknowledge that there is a distinction, I think, is the number one hurdle. The secondary hurdle is, I think, the agencies need to have a consistent track record of policing predatory lending activities in these arrangements. And that's where I think it's very important to have a strong payday lending rule. That I think might potentially help, but at the end of the day, states like New York, Massachusetts, and California are going to be unwilling to effectively increase their usury rates if they can avoid it. And that's really, I think, the biggest stumbling block to any legislative solution.
Thank you. So we have about a minute and a half left, and I see Peter already made his apparition to remind me that we're running short on time now. One last question for all the panelists. So we have an interesting question here about language access, and do you think that some of the financial services need to be provided in other language as a standard than English? So that's a question about financial inclusion. And just to dovetail on that question, and really I would like to have a 15-second answer from all the panelists. Do you think there is a contradiction between financial inclusion and the protection of the consumers regulations as they are currently? Let's start with Keith.
All right. Well, I'm not sure I quite understand the question, but I do think that, language access, very important. Some of it's included under ECOA, as I know, but on the other hand, I think the regulators need to be wary of limits. There are a lot of languages out there, and things get to be complicated very quickly.
Thank you, Dan.
I agree with Keith. I think, I'm not sure if there's going to be a sort of national standard on that one, but I think, obviously, it is important language access is an important aspect of financial inclusion.
Tom?
I agree, but I think it has to be tailored to the actual communities that you're lending to or engaging in business with. And I think to some extent that needs to be left to management of the bank.
And Paul, finally.
Well, just to answer the second part of your question, yes, absolutely. I think there can be a tension there at some point if the regulations are interpreted and enforced in a way that it makes it impossible to serve the low margin consumer, then absolutely it can hurt financial inclusion, and that is something that needs to be watched for.
Thank you profusely to all the panelists. I think that was a very lively panel, a great discussion, a lot of foods for thought. Now turning it over back to Peter. Thank you, Peter, for allowing us to participate.
Of course. Thanks, you. Well, it really was a fascinating discussion. Thank you also to Keith, Dan, Tom, and Paul. Really, really appreciate it. Reminders, just a couple of reminders here. We have this afternoon, we actually have another great session coming up on, we actually have Congressman Foster, Congressman Lynch, speaking with Phil Goldfeder from Cross River Bank, just talking about what their goals for the new Congress are going to be. We also have our own, if you're interested in Latin America, this is your week. Tuesday and Wednesday of this week, Lender Fintech has our annual Latin American event, which is proving to be really popular. So with that, I want to thank you once again. And all that information obviously is available on lender.com. And we'll see you next time. Thanks.
Thank you.
Bye.